If I could ask you all to be seated, please. I think one of the attractive features about today's program is that we're hearing a diversity of perspectives, good perspectives from specialists in the academic world, but it's very important also to hear from industry, and we're fortunate to have the heads of key industry associations available to present this afternoon. So to kick it off, I introduce Stephen Münchenberg from the ABA. Stephen? Please welcome Stephen.
That wanted me to be a short intro, but that was short. Caught me on the hop. Thank you. And look, I apologise. I don't normally do this, but I'm going to actually read my comments today. The only reason, it's not a criticism, the only reason is some of us have got submissions due on Tuesday that are sort of haunting us, so not had a lot of time to get my head around what I want to say, although what I want to say is very germane to that submission, so please bear with me. The Australian banking industry believes the financial system inquiry is an important opportunity for careful and considered deliberation on the state of Australia's financial system, its role in serving the Australian economy and hence the Australian people. Out of this inquiry, we hope to see clear recommendations on the policy settings needed to ensure the system continues to serve Australia as well in the future as it has in the past. That's why the banking industry has argued consistently that the inquiry should focus on ensuring Australia has the best financial system to meet its future needs. Now, this means having a banking system that meets the needs of household and business customers and investors and employees and the broader community. To achieve this objective, we need a banking system that is stable, resilient and safe. We need one that is competitive, innovative and diverse. And finally, we need a system that is efficient, inclusive and profitable. To ensure the banking system can continue to serve the needs of the Australian customers and the economy, the banking industry's initial submission to the inquiry focused on 5 key areas. 1, ensuring the strengths of the current system are recognised and are not undermined. 2, on funding, putting in place measures to strengthen and diversify the sources of funding for the economy, not just funding for banks either, although this will be an important component. 3, on competition, testing any impediments to more competition and, where appropriate, removing them. 4, on regulation, ensuring the regulatory regime supports rather than inhibits the financial system from serving the economy. And finally, 5, on technology, making sure the central role of technology in banking is properly understood and the regulatory regime supports the full realisation of technology's benefits while protecting customers and the system from any risks. We were pleased to see that many of the industry's proposals were reflected in the inquiry's interim report, but then the interim report did cover an awful lot of ground. The issue now is to focus on those issues that will matter most to whether the financial system can continue to serve Australia's needs. In considering what final recommendations to make, the banking industry will be suggesting the inquiry take into account a number of points. First, given the demonstrated strengths of the current system, regulatory and policy changes should only be made where there is clear evidence that the change is needed and that the benefits of the change outweigh the costs and consequences. Second, and related to the first, considerable care is needed in introducing new policy or regulatory proposals in anticipation of possible future problems. We absolutely need to be wary of complacency. Our system has done well, but it is not invulnerable. However, we need to be careful that we are not trying to solve possible or even theoretical future problems in ways that have real consequences for the system, consumers and the economy today. An example of this is the calls for ever higher levels of bank capital, supposedly to make banks ever safer, but at what cost to the bank's ability to serve the economy? We must remember that the safest car is the one that doesn't move. Next, careful consideration also needs to be given to policy proposals developed overseas. Just because someone else has done something may make it interesting, but it is not sufficient reason for Australia to do it. There are many structural and regulatory differences in Australia that mean international proposals need to be considered in the Australian context, or may not in fact be relevant at all. Examples include pre-funding our deposit guarantee, when we have different arrangements here for depositor priority, or ring-fencing banks, when our banks are structured differently and we are already putting in place resolution plans. And finally, we need to be sensitive to the timing on some of these proposals. Again, if we look at something like ring-fencing, there is no global agreement or consensus on ring-fencing. Even if we look at those jurisdictions that are introducing ring-fencing, you have a choice between Volcker, Vickers, Liikanen, or the French or German approaches. We have to be mindful of how our system is seen from overseas, especially by investors whose capital this country needs. But for that very reason, we also need to approach change cautiously and not destabilise the system today to respond to possible future issues. These are principles, but there are some specific areas the industry is likely to cover in the submission on the interim report. We are, of course, in the process of finalising that submission. And when you're dealing with 24 banks of very different sizes, that's a minute-by-minute proposition. These issues include the challenges presented by the current regulatory capital framework, particularly for regional and smaller banks. Ensuring there is a coordinated and comprehensive approach to improving the quality and diversity of funding for the economy. Recognising the considerable improvements already made to the stability and resilience of the system, and prioritising any measures to improve stability towards those that minimise upfront impacts on the system and the economy. Building on financial literacy, increasing the effectiveness of disclosure, and improving financial advice to assist customers to get the best out of their financial products and services. And proposing a collaborative approach to managing the rapid changes driven by technology. A collaborative approach involving regulators, industry and consumer representatives. This inquiry is a critical opportunity to make sure that our financial system serves our needs. The inquiry panel and Secretariat have an enormous task ahead of them to work through many complex issues and to come to a landing on the policy settings we need. That is why it is so important that we remain focused on the overall goal, a financial system that will serve Australia as well into the future as it has served in the past. Thank you, and with a similarly short introduction, I'll now hand over to Rob Whelan from the Insurance Council.
Running very much to time. I've got a short presentation which I'll run through with you, just to give you some highlights of where we see the insurance industry's position within the interim report. I think it's fair to say that the insurance industry and the general insurance industry in particular, which is the focus of my organisation, didn't feature heavily in the interim report. Now, you can see that as both good and bad in some respects, but there are a number of issues that are raised in the interim report which the industry is concerned to address. Particularly where we came into the inquiry was with a view about a higher level understanding of risk in the economy and the role of insurers in managing that risk. Hopefully this works. No? There, okay. So, is that all right? Yeah. The idea that we presented to the inquiry was that risk is a fairly unique phenomenon in the economy overall. The unique nature of risk is that unlike investments where a supplier of capital and investor can come together to do a deal, and if the deal's not satisfactory on either side, the deal disappears. Risk does not disappear. Risk will eventually land in the economy. And the critical thing that we propose to the inquiry is that insurable risk is something that needs to be dealt with efficiently, and I think the inquiry in its terms of reference looked at this as well. So our proposition was eventually it is all about the transfer of the cost of that risk wherever it may land, and our proposition is that the industry actually is the most efficient method for managing risk, insurable risk that is, Otherwise, it will land either with government or with the individual. And we've seen that in a number of circumstances where we've had disasters and so on. So we wanted to keep a view at the higher level about the role of insurance in being the risk management structure, if you like, for the overall economy. And that that needed to be understood, and that if certain regulatory settings were in place which facilitated the industry, then the industry could take on more risk and therefore free up the economy in other areas to take more entrepreneurial risk and therefore provide growth and development in the economy. So we act as a facilitation process and risk management process. Now, it's reasonable to evaluate now where the inquiry actually went. I'm really hoping this works. Yeah, okay. So what did the inquiry start to work on? Well, our view in interpretation of the inquiry is that whereas Wallace tended to concentrate on more macro level issues, the Murray inquiry appears to be looking at more micro adjustment sort of processes. The conclusion is that there is no particular case at this point for intervention. I guess the Murray inquiry is basically saying the status quo is not bad, the system's working, give me a case for intervention and prove that case with evidence-based. Post the Wallace inquiry, we had three major shocks. The GFC, obviously the ageing population, the implications for superannuation, and technology. And each of those is assessed pretty rationally within the report from our point of view. The challenge that we see that the Murray inquiry is putting, particularly to our industry, but perhaps others, is the issue of challenge of estimation. Are we getting the estimates right around the level of risk, for example, or the adequacy, for example, of retirement incomes and so on? So it's about the estimation process and whether the information process and asymmetry of information is actually conducive to or otherwise to understanding the appropriate levels of risk management in the economy and or things such as superannuation, retirement incomes. Competition is also raised in the inquiry, and it's considered to be a fundamental of the effective management of the economy. So we don't disagree with any of that, but we do see that different types of competition can have downsides as well. Continuing to try. Yeah, okay. So the inquiry really posed a number of questions from the industry's point of view that we will seek to address. And it does seem to concentrate more on the micro issues rather than the macro issues, and something that we will need to take on board in terms of our response to the inquiry. Just how bad is non-insurance in the economy overall? The inquiry poses this question to ask us, how bad is it? How big is it? What is the impact on the economy? What is the merit of intervention, potentially, of doing something about that? What's the impact of technology? Is the pool, so the basic proposition here is technology is actually giving insurers the benefit of information that allows them to risk rate at a very micro level. So individually risk-rated properties, for example, versus pools that cross-subsidise the high risk with the low risk. Ultimately, technology will allow us to pinpoint specific risk by specific properties, and that's already happening as we speak. And what are the implications for that? In the competition space, what about aggregators? Do they actually inject better competition, more information? Are they suitable to drive greater information and understanding in the consumer space or not? So there is a thrust by the inquiry into the consumer area, obviously a major issue. And disclosure. Critically, disclosure is seen to be a basic failure that's posited in the inquiry, that potentially the disclosure regime that we've lived under for some time actually has reached its end point, and new and better forms of disclosure need to be evaluated. So in terms of how we intend responding, there we are. Okay. So we'd like to reassert that framework that I showed you initially, because we do believe it is about convincing the inquiry, and for those who will set the macro regulatory settings, that risk needs to be managed efficiently in the marketplace, and that given the right sorts of settings, that the industry can actually take on more risk, which is conducive to growth in the economy. That non-insurance is an issue in the marketplace, but it needs to be defined more accurately, because in many cases a total loss, which is often where non-insurance tends to be highlighted in the media and the government and the regulator's mind, is a relatively obscure event. It very, very rarely actually happens, less than 1% of claims. But when it does happen, it is seen as catastrophic, of course. So there are great second round effects of trying to deal with that on a global basis, which has happened, for example, in New Zealand, where they have total replacement policies. The cost of insurance there is astronomical as a consequence of that initiative. Competitors on the competitive scale, do aggregators make a difference? Can we do something around getting better information into the marketplace that drives competition? We would argue that there are some opportunities there, but however there are many second round effects, because ultimately this is a distribution, it will be competed for, and it has a number of second round effects that we need to be very, very careful about, because ultimately does it actually benefit the consumer, and that's an open question. And in terms of disclosure, from an insurance point of view, as I go back to the original structure that I mentioned, is that risk does land ultimately in the marketplace. It will have an effect, it will be distributed, it will incur costs. Can we do it most efficiently? Well, disclosure is about us getting a better understanding of what that risk is at an individual level or at an enterprise level, and how best to manage that cost effectively. And that's the area that we would like to try and concentrate on, because ultimately the biggest risk in this environment and this industry is people not taking out insurance at all. So that is the biggest risk. There is very little damage by taking out an insurance policy to the individual. So at the macro level, we're arguing that the insurance industry can do more. It's structured to do more. It's well capitalised and could do more, given that it has the right settings and is understood in terms of its overall role in the economy. So now I'm hoping to introduce John Brogden. Yes, he is here from the Financial Services Council. John, over to you.
That's the most emotional and passionate introduction I've ever had. Rob, thank you very much. Thank you. Look, firstly, can I thank you very much for the opportunity to come along today. Peter Mason, the Chairman, and David Gallagher, thanks for the chance to be here. And I do want to acknowledge the godfather, I'm trying to work out the right phrase for you, Mark, the godfather of financial services trade in Australia, but and say how wonderful your leadership has been in this area, and I know you're speaking later today and you'll share in all of that. I've been asked to cover off the Financial Services Council's view on the Murray Review's interim report. I'm going to presume that you have read it, or you, in a major sense, understand its direction, and I'll lead you directly to talk about some of the concerns we have about it and the directions we'll be pushing in the next stage report and what we're hoping for to come out of it. Look, ultimately, and maybe somewhat controversially, we're quite disappointed with the Murray Review to date. It was, I guess, pretty obvious from the outset early on when David Murray indicated there'd been no shift away from the 4 pillars policy, that there was not going to be a major recommendation with respect to banking or with respect to the efficiency and effectiveness of the financial system in Australia. And that's borne out in the interim report. Our concern is that what we've now seen from the perspective of superannuation, funds management, financial advice, is a lot of recommendations that fall into 2 categories. One, they drop down into the weeds, what we would regard as the weeds of the financial system, and some significant and important and well-reported findings that are based on poor and, in some cases, lazy information. So let me turn to the former category, the latter category first. You'll have seen that a significant focus of the interim report was on the cost of superannuation. And the clear indication was that the Australian superannuation system is expensive by international standards. We have real concerns about that proposition. The first concern is that it is very hard and indeed very foolhardy to compare the Australian superannuation system with the broader pension system in the world without taking into consideration, not unique, but some of the specialised features of our system. It is really quite dangerous to compare Australia's defined contribution, full service superannuation system with a defined benefit system in Europe. They are extremely different beasts. The product features that exist, and we can have a separate debate about whether there are too many bells and whistles, but the fact of the matter is Australian superannuation funds are required to provide life insurance. They're required at a default level to have access to advice, and they're required to be positioned as such and built as such to be able to be transferred by members at will. In contrast, a DB system is extremely different. It doesn't require the features of advice, it doesn't have a requirement for insurance, broadly speaking, and it certainly doesn't provide for people to switch from one fund to another in the same way that our system does. So there are built-in features in the Australian superannuation system that make it vastly different and carry a different set of costs to the traditional European-style DB system, against which it has been compared by and large in the Murray inquiry. The obvious point that flows from that is it is equally hard to compare the investment strategy and asset allocation in a defined contribution fund with the investment strategy and the asset allocation in a defined benefit fund. They are seeking two very different outcomes, and it is therefore quite improper and quite dangerous to compare the investment strategies, the investment costs of those two systems. The other large mistake we think that the Murray Review has undertaken with respect to superannuation is a concentration on the last couple of years' worth of fees in super funds. What it ignores, to its credit, it does acknowledge that MySuper, a large and new regime, is now in place. But what it ignores is the fact that it is far too early to realistically measure the performance of MySuper in reducing fees. Our research shows, done independently for us, that the average fee now for a retail superannuation fund in the default space is sitting at 73 basis points. Now that's very internationally competitive. That's after less than 12 months in real terms of MySuper operating. And what it indicates is there is more room to move. Also ignores in part the fact that, that's a hint, isn't it? It also ignores in part the fact that the cost of the superstream element of the MySuper package, which is the significant expenditure in terms of improving systems to allow for transferability of funds, for consolidation of accounts, etc., has cost the industry hundreds of millions of dollars in terms of levies. So in essence, Superstream and MySuper were always going to cost money to save money in the medium to long term, and we're still at that phase. Even having said all of that, we see in the retail sector the average MySuper product sitting at around 73 basis points, which is even at that point internationally competitive. In terms of, we have a major concern. So we'll be submitting to the Murray Review more up-to-date data, more international comparisons on where we think the default system in particular is performing and why it is not, we think, an appropriate recommendation to indicate that our system is internationally expensive.